What is the easiest way to get rich? Hi everyone, I'm Ava, and today we're going to talk about compound interest and how it relates to your financial journey. Compound interest is often called magic, or the easy way to get rich in the financial community. And it is. In fact, Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." But why is compound interest so magical? Let's get started and talk about what compound interest is, how compound interest works, and how you can use compound interest in real life to become a millionaire one day. So what is compound interest? In a nutshell, compound interest is when you earn interest on interest. This is in contrast to simple interest, in which you only earn interest on your principal investment no matter how long you keep your money invested. Let's take an example and say that you put $1,000 into a bond, a stock, or any other financial product with an interest rate of 5%. So in year one, your starting balance is $1,000 and you'll earn $50 interest over the course of the year. That's this interest rate of 5% multiplied by your starting balance of $1,000, giving you a total ending balance of $1,050 in year one. In the first year of your investment, there is no difference between simple interest and compound interest. You always start with your $1,000 investment and earn $50 in interest on it. Again, that's this interest rate of 5% here multiplied by your starting balance of $1,000. Giving you a total end of year balance of $1,050 in year one. It's only the year after that, year two, where we begin to see a difference between simple interest and compound interest. With compound interest, the $50 interest you made in year one is going to earn interest as well. That's the interest on interest I mentioned before. So under compound interest in year two, your starting balance will be the $1,050 you have at the end of year one. Your initial investment of $1,000 plus the $50 in interest you earned in year one. Multiply this $1,050 by 5% and you'll earn interest of $52.50, giving you a total balance of $1,102.50 at the end of year two. With simple interest, unlike with compound interest, the $50 of interest you made in year one wouldn't earn any interest at all. You'd continue to earn 5% on your original investment of $1,000 only. So while your total balance at the beginning of year two will still be $1,050, the same as under compound interest, you'll only earn 5% interest on your initial investment of $1,000, meaning you'll earn the same $50 of interest in year two as you did in year one, giving you a total ending balance of $1,100 in year two. That's your initial investment of $1,000 plus two yearly investments of $50 each. So at the end of year two, you'll have $1,102.50 in your account under compound interest, versus only $1,100 under simple interest. At first, this difference of $2.50 might not seem like such a big deal. But over the years, the compounding begins to add up a lot and make you much more money than simple interest would. Let's take a look at the differences between simple and compound interest over time. Sticking with our initial example of $1,000 earning a 5% interest rate, after 5 years, compound interest would give your investment a total value of $1,276.28 versus just $1,250 with simple interest. So we're starting to see some differences. $26.28 more isn't bad, but it only gets better with time. After 10 years, compound interest would give your investment a total value of $1,628.89 versus just $1,500 with simple interest, a more substantial difference of $128.89. The reason the difference between simple and compound interest increases with time is because after a longer period, you'll have more money from interest that, under compound interest, will earn interest as well. Simple interest, on the other hand, will continue to return the same $50 interest per year on that original $1,000, regardless of how long you've had your money invested. That's why after 20 years, compound interest would give your investment a total value of $2,653.30 versus just $2,000 with simple interest, a difference of $653.30. And after 30 years, compound interest would give your investment a total value of $4,321.94 versus just $2,500 with simple interest, a significant difference of $1,821.94. Looking at these numbers here, it's not hard to see why compound interest is considered so magical when compared to simple interest. And we can also see that the most important part of compound interest is giving your money time to grow. But this doesn't have to be a hypothetical scenario. You can use compound interest in your own life to earn even more money. The example we just looked at used a hypothetical interest rate of 5%, but in real life, that can be a lot higher or lower. It all depends on where interest rates stand and what you invest in. For example, if you want to invest in stocks or shares of companies, there's a wide range of indexes you can invest in. For our purposes, we'll stick to the S&P 500 as an example. The S&P 500 tracks the 500 largest companies in the US by market capitalization, giving you a diversified portfolio of stocks to invest in. If we look at the past 60 years, the S&P 500's average annual return has been around 10.5%. Of course, this doesn't mean that you'll definitely get a return of 10.5% after 1 year if you start investing in the S&P 500 today. In any 1 year, the actual return might be higher or lower, or even negative in bad years. What it does mean is that over the past 60 years, your hypothetical annual return likely averaged out to be around 10.5%. And because no one can predict the future, that's probably the best guess we have as to how the stock market might perform in the future. But it's just that, our best guess, and not a guarantee. As we've seen though, the most important part of compound interest is time. So if your goal is to become a millionaire one day, starting to save early and keeping your money in an index like the S&P 500 for a long period of time might be the way to go. So how can you use compound interest in real life? Well, say that you start investing when you're 18 and put $100 into the S&P every month. To highlight the power of compound interest, we'll also say that you invest for only 10 years before stopping and investing nothing more. Here's what those numbers would look like. After these 10 years, at age 28, you'd have invested a total of $12,000, $100 per month for 120 months or 10 years. Assuming annual compounding and using an average rate of return of 10.5%, this would already compound to $19,589.50. The real magic, though, comes from letting that $19,589.50 sit in the investment and compound. After another 10 years, at age 38, you'd have $53,167.49 without contributing a single dollar more. And after another 10 years, at age 48, again without any added contribution, you'd have $144,300.86. By the time you're 65 and ready to retire, you'd have $787,821.49. Again, assuming you'd started investing at 18 and stopped putting in any new money at age 28. So the $787,821.49 came all from the initial $12,000 that you first put in. But you probably want to know what you need to do to become a real millionaire. You could earn even more if you keep investing after 28. Take a look at this chart. This red line here shows you the amount you could earn if you invest $100 every month from the age of 18 until you're 65, instead of stopping at 28 like in our previous example. Over $1.2 million. And your total actual cash contributions, which are shown by this blue line here, would only have been $56,400, $100 every month for the 47 years, or a total of 564 months from the age of 18 to 65. we can see how, as time passes, your investment's value balloons into nearly 22 times your total contribution, all thanks to the magic of compound interest. If you're feeling anxious because you're still young but don't have the money to start investing right now, or if you're already a bit older and think it's too late for compound interest to work its magic, don't worry. Of course, the earlier you start, the more time your money will have to grow. But even if you start investing at age 38, 20 years later than in our previous example, you could still get to the similar $1.2 million like we showed you here. But you would have to invest quite a bit more each month. Instead of $100 per month, you would need to invest about $785 a month into the stock market, with, again, an assumed average annual return of 10.5%. And by the time you're age 65, so 27 years or 324 months later, you'd end up with $1,239,647.26. That's still nearly $1 million more than the $254,340 you'd actually have contributed. And that's how compound interest can make you rich, if you start early enough and give your money time to work for you. But it can be hard to figure out how much you should invest, or how often. A compound interest calculator, though, can do all the hard calculating for you. This compound interest calculator from investor.gov is what we use today to calculate all the numbers in the various examples we've shown you. We've linked it below for you, so you can use it yourself. But let's do a quick walkthrough to make sure you're familiar with it. Here, you can put the amount of money that you initially invest. Let's put in $0 just as an illustration. Just below, you can put the amount of money you'll contribute every month. For example, $100. Note that this field isn't required, but to grow your money long term, monthly contributions help greatly. Below that, you can put the amount of time your money will have to grow. Let's pretend you're 25 and want to retire when you're 65, in which case you'd put in 40 years here. Then you put in the estimated interest rate, and below that, the interest rate variance. It's important to know that in most cases, like when you're investing in the stock market, this rate is just an estimate, and the real number might vary, though it should be somewhat similar. We'll use a 10.5 interest rate with a 0% variance just to keep things simple. Next, select the compound frequency, or whether your money is going to be compounding daily, monthly, quarterly, semi-annually, or annually. We've used annual compounding throughout this video, so we'll select that. Finally, click Calculate, and the results are in. You'll see the amount your investments would earn here. From your contributions of just $48,000, in 40 years, you'll have $608,701.89, and a nice chart showing that growth. That's all we have about compound interest for today. Let's recap what we covered. Compound interest is when your interest earns interest. The more time your money has to grow, the more you'll earn. Compound interest makes you way more money than simple interest would. If you start early enough and make small, regular monthly investments, you can become a millionaire by retirement. The later in life you start, the more you'd have to contribute each month to reach the same goal. A compound interest calculator, like this one here, can help you figure out how much you should invest. We hope you learned the fundamentals of compound interest today. Make sure to like and subscribe to our channel if this video helped you, and leave a comment about any other personal finance topics you want us to cover. Thanks for watching, and we'll see you again next time.